Hello, this is Business Edge on News Central. I'm Tolulokwe Adeleru Balogun. Our headline stories: South Africa's Treasury to change pension fund rules, and the country starts new minimum wage payment. The African continent is seeking homegrown solutions as she battles debts, reduced income, and economic recovery in the wake of the pandemic. South Africa's National Treasury is proposing a change of rules governing pension funds to encourage investment in infrastructure projects. And also, a new minimum wage has also started in the country. Will it ease the burden of wage disparity? Will it yield the much desired results of cushioning the effects of COVID-19? These are our focus today. Welcome. This is Business Edge. Now, before the coronavirus-induced lockdown, South Africa already had its work cut out for her. The current economic recovery of Africa's most industrialized economy was and is under substantial strain. Economic growth fell to 1.5% in 2019 compared to 3% in 2010. Also, in the fourth quarter of 2019, the economy entered a technical recession. From there, things got worse. The GDP fell for 4 consecutive quarters in 2019 all the way to 2020 and put the country in a severe recession in 2020. Now this is 2021 and South Africa is trying to find its way back, not just from that, but also from the economic effects of the coronavirus. However, in a bid to encourage post-COVID-19 economic development, South Africa's National Treasury is proposing changes to Regulation 28 of the Pension Funds Act. Regulation 28 applies to pension, provident and retirement annuity funds and essentially limits asset managers' allocations of retirement savings to certain asset classes, including equities, property, and foreign assets. In a statement, the Treasury said the changes should make it easier for retirement funds to invest in infrastructure and allow for better measurement of investment in projects. The Treasury further stated that changes are informed by a number of calls for increased investment in infrastructure given the current low economic growth climate, stressing that the decision to invest in any asset class remained up to the Board of Trustees of each fund. However, the proposed PFA amendments do not introduce infrastructure as a new asset class alongside existing ones like equities, debt instruments, and property, but it allows for infrastructure investments to be recognized within those asset classes. The National Treasury said overall investments in infrastructure across all asset categories may not exceed 45% of domestic exposure and an additional 10% for the rest of Africa. Joining me on the show is Ekos Akpokabayen. He's the Chief Investment Officer of Ovid Capita, joining us from Johannesburg, South Africa. Ekos, welcome to Business Edge again. Thank you so much for joining us.
A good day. Thank you for having me.
So let me first ask, why are we seeing this push? Now, we're seeing that pension funds are a very serious and sensitive area for conversation and legislation, but what really is pushing South Africa to make some of these amendments?
There's been a lot of push in the last 3 years, and South Africa has been looking for bailout. Instead of looking for bailout elsewhere overseas, there's been demand for, the South African government to put their hand in the jar of the pension fund to bail out struggling state-owned entities like Eskom, like Transnet, like South African Airways. There's been a lot of call on that. I think this is the closest move the government is taking close to putting a hand on the cookie jar. A lot of people, business world, are thinking, why going elsewhere? Why is South Africa struggling to find capital elsewhere? But I must point out that why South Africa has been struggling the last 3 to 4 years is because of the downgrade. The South African economy was downgraded to a junk status, and also the state-owned entities like Eskom and Transnet, and this has been a burden to the fiscus of the country.
Okay, so let's look at the classifications before we go further into this. So they're saying that this is for increased investment in infrastructure projects, but the amendments don't actually create another class, as we talked about in terms of equities, debt instruments, and property, but it allows infrastructure to come in in under those classes, sort of like a subclass of each one. Does this work out? What do you think? Should infrastructure be its own class on its own, or it will be sufficient to have it being recognized within the asset classes that are already spelled out?
I think those pressures coming from the political angle. This is just a way to, to balance between foreign investors, World Bank, IMF. I think it's almost the same thing. Of course, you see investment trickling into infrastructure. One of the aim here is when you look at Eskom is an infrastructure a utility company, and it's been struggling on Transnet. I think this is just a way, if you say infrastructure coming under debt and equity, I mean, it's almost the same thing, because at the end of the day, the money and the funding will still find its way to those asset classes.
All right, so we know Regulation 28 is part of the Pension Funds Act, and the purpose is to protect investments against poorly diversified investment portfolios and aims to ensure that investors' hard-earned money is invested in a sensible way without too much exposure to risky assets. So can we have some specifics on what changes are really being proposed? Since we've talked about the asset classification for infrastructure, what specific changes are we looking at?
The specific changes is to allow this fund to invest in within the asset class of debt and equity and real estate, and then it allows infrastructure to invest within those asset classes. So although the decision still lies with the fund managers, but of course there will be pressure from the politicians. The aim here is to help these infrastructures in the country that are struggling, like I mentioned, like Eskom. I'm not truly in support. I think it's a good idea if you look at it on plain sight. But with the mismanagement we've been seeing in the country and the corruption over the last few years, this is going in the wrong direction in the long run.
In the long run, that's heavy. So let me ask you about some more criticism and support for this. There are proponents of Regulation 28, and they believe that this legislation is effective in protecting pension fund money from high-risk investments. However, critics say that it is unfair to expect long-term investors to dilute their potential returns. Where do you stand on this? Again, given the statement you just made before my question, in terms of in the long run, you don't think that this is a good idea.
Yes, look, when you look at South African economy, you'll see that the pension fund is about 40% of the GSC. So South African economy is not big compared to other nations. The largest pension fund in the world is the Japanese pension fund, and they're big enough and they're more experienced to take some of the risks they take. Even at that, they're always very careful. When you get old, you want to get your pension. You've worked all your life, you don't want anything to go. So Rule 28 is supposed to protect you. When we see this kind of things, it's just a step. Every problem starts from a step. And it looks in plain sight, it looks okay, but in the long run, like I say, it's very risky, especially for the pensioners.
Let's talk about that long run a bit, because there's some limits. Now, investing in Regulation 28 compliant funds mean that 70% of the assets must be invested in South African assets. And this is going to be a bit difficult, given the rate at which the number of listed companies on the Johannesburg Stock Exchange has shrunk over the past few years. This means that investors actually have limited choices when it comes to investing in local companies. How is this attractive in the long run? Is this an issue? Because now you've talked about the comparison with the Japanese stock exchange, looking at the fact that the JSE in South Africa has shrunk over the years. So there's a limitation to where investors' money from pension funds can go. Is this really attractive in the long run?
Look, in the long run, if things are managed properly, you see, I've been talking about corruption and managing things properly. What we've seen now, currently in South Africa, we have the State Inquiry of Commission, and it's not been going well. The judiciary has been under attack. A lot of people who have mismanaged, overpricing, racketeering, they've not been brought to book. And that's the concern. When you look at the country, these things on hindsight look okay. But when you go underneath and see how these institutions have been mismanaged, then you begin to worry. Yes, I understand you're looking for room to grow, but the underlying issues have not been fixed. One of the issues that created the joint status was not fixed, and we were calling at the time that it would be detrimental to the country. And at that time, people some other people and politicians were saying, look, we don't need to talk about S&P moodily. We need to create our own standard measuring company for grading. And I think when you keep going that kind of route is very dangerous, and that's what we're seeing here again.
What role do you think politics is playing in this? This is, I think, the second time you've mentioned sort of the political climate in South Africa. What role do you think politics is playing in these amendments that are working to put hands in the pension funds?
Yeah, it's playing a lot of role. Of course, the way South African political sphere has been set up is playing a lot of role. There are those who are calling for radical economic transformation. Sometimes we begin to question what is real radical. And there's those that say radical meaning changing the status quo in a big way that it would create an upset in order to cut the gap of inequality. But in essence, South Africa is tied to the global economy and the global world, and those kind of things are very difficult. We've seen, for example, in countries like Zimbabwe, they've been in big trouble. We've seen Venezuela. We've seen some other countries who have gone that route. It's a very dangerous route. And I know the president and some people in the quarter say you can't go through that route. So in the political world, talking to the economic world, is the radical economic transformation people that are really pushing these kind of things and saying, why do you need to go on your knees to the World Bank or IMF? We have some money here and we can tap on that money. But I think that's dangerous.
I want to ask quickly before I ask my next question, what's the overall sentiments from South Africans in regards to this? As you mentioned earlier, you work all your life. You want to know that your pension fund is there for your retirement and to ease your golden years as it may be. But this is coming at a time when the country is still in recession, trying to get over COVID-19 as well with many other countries around the world. How do South Africans feel about this, that governments may be able to get their hands on their pension funds in, of course, a restricted and regulated way as it may be?
Bad news, I think it was last week. We have the highest employment we've ever had in record, is about 37%. And so those who have a job, they are the ones that have paid pension. Of course, they don't want their pension to go away in thin air or be mismanaged, and that's very risky. We've seen it in a few countries. But those that don't have a job, they're not even thinking about that at the moment, which is a large population of the country. So, of course, if you put that in perspective, people are trying to look for a job in the first place. And those who have a job, who have been able to keep a job to earn a pension, they're quite worried. But that number, you'll see that number begin to drop. But for many years, South Africans have not shown interest for their pension fund to be touched. It's mostly the politicians who are looking for bailout everywhere.
All right, so before we go for a break, let me ask this. Now, given that South African shares can be particularly volatile in the short term due to currency fluctuations, the 70% asset allocation can make some investors a bit uneasy. It also means that investors can only allocate about 30% of their portfolio towards global industries, many of which include technologies and innovations that do not have local equivalents. With COVID-19, load shedding, you've mentioned corruption, as well as mass unemployment, many analysts say now is a good time to have more global weighting in one's portfolio so as to protect against further deterioration of the local economy. Do you agree with this? And then in terms of how this is meant to play out and get the best return for investors, how do we make this work? How does South Africa make this work?
What South Africa needs to do is to go back to the basics. You know, we can hear all these numbers, but the basics are very important. Like we go from where we got it wrong. And I will repeat again, when we got the junk status. When you get a junk status, you need to understand what that means. It means it's hard for you to get capital. It's hard for you to get certain investment from different quarters in the world and other funds. They wouldn't invest in a junk status country or company. And that has been hard. And even when you get those funds that are willing to invest, they invest with higher returns and higher scrutiny. So that has been the problem, attracting investment money and good money that we have been enjoying for many years. And of course, you know, who to blame are the politicians because they don't understand how this works. And now we're in a position where we want to fix it. We need to fix those things that have been wrong with these agencies that measure. Once we put that in place, we will begin to see the kind of investment we were seeing in the mid-2000s and the early 2000s.
All right, Ekos, we're going to go on a quick timeout. When we come back, we move the conversation to the new South African minimum wage. Who benefits the most? Are there any exemptions? We'll try to give you the details right after this. Do stay with us. The new minimum wage of 21 Rand 68 cents per hour has kicked off in South Africa. In early February, the Employment and Labor Minister announced that the national minimum wage for each ordinary hour worked will, as of March 1st, 2020, increase from 20 Rand 76 cents to 21 Rand 69 cents. In a statement, the Department of Employment and Labor said it considered inflation, cost of living, and the need to retain the value of the minimum wage, as well as gross domestic product, wage levels, and collective bargaining outcomes. It also considered productivity, ability of employers to carry on their businesses successfully, operations of small, medium, or micro enterprises and new enterprises as well, and the likely impact of the recommendation adjustment on employment or the creation of employment. Ekos Akpokabayen is still with me on Business Edge. Ekos, take us through this a little bit. Is there any exemption to this new minimum wage hike, or is it for everyone and anyone?
There's an exemption procedure that the Minimum Wage Act has for companies who genuinely cannot carry this bill. They can follow that procedure and the process through the department, and they will be exempted from the minimum wage bill.
So this is for all class of workers across board?
Yes, of course. This is mostly for all workers, but when you look at the professionals like your lawyers, accountants, doctors, professionals, the minimum wage does not apply to them.
Okay. All right. So the statement from the Department of Employment and Labor said it considered the operations of small, medium, or micro enterprises and new enterprises and the likely impact of the recommendation adjustment on employment and the creation of employment. So you've just mentioned now about the employers who may not be able to pay and that there is a process, a procedure, a form to fill that they can go through this. So let me take you back now to the professionals. Why exempt the professionals, the doctors and the lawyers, as you mentioned? Do we have some reasoning behind this?
Yeah, the reasoning behind this, I think, is quite simple. When you look at the people this minimum wage bill really want to protect, the really people, the poorer workers who have been exploited. A lot of farm workers are exploited here, mine workers, domestic workers, it's those kind of workers you see, because they are lower in the economic employment chain, and they are always exploited. So that's where this minimum wage is especially to work on. But when you look at the professionals and doctors and all that, they're not suffering from that kind of exploitation. And mostly they have their rights, they're educated, and they're really protected. And not to disrupt those business activities as much as it would be disrupted when you look at the farm workers in the large numbers.
Okay, so I think this particular wage increase now is going to bring farm workers up to the national minimum wage, I believe is for the first time. It's also going to impact very positively on domestic workers. Who do you think benefits the most from this new minimum wage, and how does that then benefit the economy as well?
Look, South Africa has the highest inequality in the world. This is just a tip of the iceberg, but there's a lot. But one of the areas we refuse to recognize also the inequality between the education of the top earners and the low earners. But at least I think this is in the right direction. The workers, especially like I mentioned, the mine workers, a lot of the mine workers will benefit. If you remember, if you are aware, in 2012, in September 12, 2012, we had the Marikana massacre. And that process was very bad in our history, where mine workers were shot in broad daylight, and it was because they were protesting that they were not participating in the resources and the profits enough from these mines. And so you see, mine workers have been exploited, the farmers have been exploited, domestic workers. So those are the people mostly that will benefit to at least not be exploited. They should not be living under below the poverty line in any way if they have a job. And that's what the minimum wage is going to do to benefit. But although we understand that, some employers will try to reduce where they can have more labor, more hand, We understand that, but at least those who are working, they should have some dignity.
Okay, so as you mentioned, South Africa has one of the highest, if not the highest level of inequality in the world, which is measured by the commonly used Gini index. Now, inequality manifests itself in South Africa through skewed income distribution, unequal access to opportunities, regional disparities as well. And low growth and the rising unemployment have contributed to the persistence of inequality. So this is a new minimum wage. Do you think, I'm not saying that this wage is going to solve all those issues that have historical background as well, but can this minimum wage start getting South Africa on the path to addressing its high level of income inequality?
Yes, I think, when you disrupt something at the beginning, some employers will not like it. They will not want to adjust to it. But over time, investors, employers, company, we understand this is their wage bill and they'll get used to it. So there will be a disruption in the beginning, but over time, companies will be used to it. So yes, it's very welcome. I think it's going to impact, especially those that have a job. I mean, you can't have people having a job and they're exploited and living so badly. So at least there's a minimum wage where they can have a decent living and decent life, especially when they have a job. The argument is that less people will have jobs, but at least let's focus on those that have a job to have a decent job. And let's try to get those that don't have a job to get a job.
Okay. And finally, South Africa has a large percentage of foreign workers who mostly come from other African nations to do some of these low-wage jobs. Are they going to be able to benefit from this?
Look, South Africa is a very decent country, and I must tell you there's a rule of law. As long as you're legal in the country, you have all your documentation and you're properly employed, and you pay your taxes and you follow all the rules here, definitely you will benefit, there's no doubt. If you're not benefiting, that means you're illegal in the country.
Okay. Ekos, this is where we'll draw a curtain on our conversation today. Thank you so much for joining me on Business Edge.
Thank you so much, Tolu.
All right. So we've had a conversation on South Africa's plans to open up its pension funds for infrastructure projects. And of course, these are just draft amendments right now. They have not been approved, but there is a lot of conversation. And we've also touched base with the new South African minimum wage that has come into effect. Now let's touch base with NC4 to watch as we wrap up today's show. We start where else? In South Africa. Now, the South African tourism industry has disclosed that the country risks losing out on millions of rand because of concerns around the so-called South African variant of the COVID-19 virus. The variant, which was first discovered by scientists in the country, has unfairly led to the country being targeted as a destination for tourists to avoid. Because of this, major lucrative events such as the planned Lions Rugby Tour were in jeopardy, and accommodation and flight booking were already being cancelled. Kenyan and British parliamentarians are currently considering the ratification of a trade agreement that seeks to grant Kenyan goods unfettered access to the British market as part of new trade arrangements following the Brexit vote close to 4 years ago. The Trade Pact, which is a replica of the Economic Partnership Agreement that the East African Community member states signed with the EU, is expected to take effect by March 31st upon exchange of the instrument of ratification by Kenya and the UK. Nigeria's external reserves have declined by $1.1 billion in February, according to statistics obtained from the Central Bank of Nigeria. The reserves, which stood at $36.19 billion as at the beginning of February, fell to $35.09 billion as of February 26th. And finally, Egypt's Minister of Petroleum and Mineral Resources, Tariq El Molla, has held a meeting to review the executive situation of the nationwide program for converting cars to run on natural gas and expansion of compressed natural gas filling stations. And that's it on this edition of Business Edge. Don't forget to follow us on social media. We are at News Central TV. And if you've missed any of our business and financial stories from the continent, head to our website and to YouTube. Until next time, I'm Tolulope Adeleru Balogun.